When a decentralized corporation empowers its divisional managers with autonomy, those managers naturally act to maximize their own individual metrics. If left unchecked, these competing self-interests place the organization under severe stress, and the friction damages the financial health of the parent company. To manage this tension, companies implement a mechanism called negotiation-based transfer pricing. This is a deliberate middle ground between strict cost-based accounting mandates and operating in an entirely open market. The primary advantage of this approach is choice. Managers retain the autonomy to decide whether they want to buy and sell components internally with their sister divisions or source their business out to the external market. But that autonomy requires extensive transparency. To negotiate a reasonable internal price, managers must be willing to share sensitive internal cost data along with external market intelligence. This requirement frequently leads to time-consuming divisional conflict. If these negotiations fail and divisions refuse to cooperate, the company risks suboptimal utilization of resources. Corporate cash bleeds out to third-party vendors, while internal factory capacity sits idle. Transfer pricing is an engineering problem. The goal is to design a mathematical framework that aligns a manager's desire for individual profit with the overarching financial objectives of the corporation. In management accounting, we call this alignment goal congruence. We can measure exactly how this works by looking at a technology manufacturer split into two distinct entities: Division A, the component supplier, and Division B, the final product assembler. Division A incurs a strict marginal cost to manufacture the baseline component. Marginal cost is the specific expense of producing one additional unit of a good. Once transferred, Division B incurs its own separate processing costs to finish the product. Division B then takes that final assembled product and sells it to an external consumer for a final selling price. The central variable in this system is the internal transfer price. We need to determine the precise dollar amount Division A should charge Division B for the raw component. To find that exact price, we must establish a mathematical corridor. This is a defined range of acceptable prices, where both division managers record a profit, and the corporate parent maximizes its total margins. This diagram illustrates the transfer pricing corridor, functioning entirely within two absolute boundaries: a lowest acceptable price floor and a highest acceptable price ceiling. The floor is the minimum transfer price, strictly determined by the supplying division, Division A. The formula for this floor is the additional outlay cost plus the opportunity cost. Additional outlay cost breaks down into the supplying division's marginal cost plus any incidental expenses incurred during the transfer, such as storage or transportation. The ceiling is the maximum transfer price, and this is strictly determined by the purchasing division, Division B. The purchasing manager sets the ceiling by finding the lower of two numbers, the net marginal revenue or the external buy-in price. Net marginal revenue is calculated by taking the final selling price per unit and subtracting the purchasing division's own marginal cost to process it. Any negotiated price inside these mathematical bounds guarantees goal congruence. Prices falling outside these bounds mathematically guarantee a financial loss for one of the divisions. Let's populate this diagram with baseline data. Division A's marginal cost is 10 rupees. Division B's marginal cost is 5 rupees. Division B's external final selling price is 20 rupees. First, we calculate Division B's net marginal revenue. We subtract their 5 rupee marginal cost from the 20 rupee selling price. This sets the ceiling at 15 rupees. Next, we calculate Division A's minimum transfer price. In this closed scenario with no external market, the opportunity cost is 0. The floor locks at Division A's 10 rupee marginal cost. We now have our first goal congruence range, bounded between 10 rupees and 15 rupees. In a closed ecosystem, any negotiated price between 10 and 15 allows both managers to profit. The basic negotiation model functions exactly as intended. Now we introduce a market shock. An outside vendor offers to sell the raw component directly to Division B for 14 rupees. This directly impacts the ceiling formula. Division B must look at its net marginal revenue, which is 15, and the new external buy-in price, which is 14, and choose the lower number. The ceiling instantly drops to 14 rupees, shrinking the corridor. If Division A wants to make the internal sale, they have to lower their maximum asking price to 14 to remain competitive. If the external vendor instead quotes a price of 18 rupees, the dynamic changes. Division B will immediately reject the 18 rupee quote. Paying 18 rupees exceeds their 15 rupee net marginal revenue, which guarantees a loss on every unit. The maximum price ceiling stays firmly at 15. External supply prices only compress the negotiation corridor if they undercut the purchasing division's existing internal profit limits. Let's introduce a final market shock. Division A finds an external buyer willing to pay 12 rupees for the intermediate component. Meanwhile, Division B still holds its external vendor quote at 14 rupees. This external buyer activates the opportunity cost variable in Division A's minimum price formula. We calculate the opportunity cost by taking the external sale price of 12 rupees and subtracting Division A's 10 rupee marginal cost. This equals 2 rupees of lost contribution margin for every unit they choose to sell internally instead of externally. We recalculate the floor. The 10 rupee marginal cost plus the 2 rupee opportunity cost sets the new absolute minimum at 12 rupees. The final goal congruence range is now highly compressed, fitting precisely between 12 rupees and 14 rupees. When both divisions have viable external market options, the internal negotiation space shrinks drastically. Finding the exact final price, say 13 rupees, is now entirely dependent on the individual bargaining skills of the two managers. Consider the failure state. What happens if these high-pressure negotiations break down entirely and Division D simply decides to buy from their external vendor for 14 rupees? This creates the idle capacity trap. If Division A fails to secure the internal contract and has no external buyers, their factory sits idle. The corporate parent bleeds cash covering Division A's fixed costs, while Division B simultaneously sends company capital out the door to a third-party vendor. In this specific scenario, top management intervention becomes a requirement. Executive leadership must step in and force the internal transfer to ensure corporate resources are used optimally across the board. Managerial autonomy drives the core philosophy of negotiation-based pricing, but executive oversight provides the mandatory safety net against divisional self-sabotage. To maintain that balance, we return to the boundaries. The minimum transfer price floor is the additional outlay cost plus the opportunity cost. The maximum transfer price ceiling is the lower of the net marginal revenue or the external buy-in price. And net marginal revenue is always the final selling price minus the purchasing division's processing marginal cost. Mastery of strategic cost management requires understanding these formulas in action. Transfer pricing acts as the vital mathematical bridge connecting external market realities directly to a company's internal cost structure.